Imagine waking up tomorrow morning. Your salary has just landed in your bank account. On the way to work, you stop by the supermarket, but half the shelves are empty. The cashier shrugs and apologizes, explaining that the prices changed again this morning. After work, you try to withdraw some cash, only to be told you can only take out $50, no more. Your landlord messages you this evening. Starting next month, rent must be paid in US dollars. The evening news insists everything is under control. But your neighbors are already queuing outside the bank. Panic has arrived, and it feels like it happened overnight. Except it didn't. Every economic collapse you've ever heard about, from Argentina to Zimbabwe, from Lebanon to Venezuela, began years before anyone realized something was wrong. Tiny cracks appeared, one after another, ignored by almost everyone, until one day the entire structure gave way. And what makes it so fascinating? There's one country that seems to break every rule. A country with more debt than almost anyone else on Earth. A country economists have predicted would collapse for decades. And yet, somehow, it never did. Today, we're going to solve that mystery, because once you understand why nations collapse, you'll never look at it the same way again. Most people imagine economic collapse as a single catastrophic event. A stock market crash, a revolution, a banking crisis, a government default. History tells a different story. Think of a giant concrete dam. At first, a tiny crack appears. Water slowly begins to leak through. Nobody panics. The dam still looks enormous, strong, safe. Then another crack appears, and another. Engineers notice, but most people don't. Months pass, maybe years. From the outside, everything still seems normal. And then one day, the wall gives in. The flood wasn't caused by the final crack. It was caused by every crack that came before it. Countries collapse in exactly the same way. Not with one terrible decision, but with hundreds of small ones. Which raises an important question. What's usually the very first crack? Well, surprisingly, it isn't inflation, it isn't unemployment, and it isn't even debt. It's confidence, or more accurately, the slow loss of it. Imagine you're a bank. Someone walks in asking for a mortgage. Do you lend them money? Maybe, but only if you believe they'll pay you back. If they're unemployed, covered in debt, and have missed every previous payment, you'll demand a much higher interest rate or refuse altogether. Countries work exactly the same way. Governments borrow money every day to build roads, fund hospitals, invest in infrastructure, respond to recessions. Debt by itself isn't unusual. In fact, every major economy has it. The real question isn't how much debt does a country have, it's do investors still believe they'll get their money back? Because once that answer begins to change, everything else changes with it. Argentina is one of the clearest examples. For years, investors were happy to lend the country money. There were warning signs, rising deficits, political instability, policies that changed every few years, but nothing that seemed catastrophic. Then confidence began to slip. Not all at once, but little by little. Lenders demanded higher interest rates, borrowing became more expensive, servicing old debt became harder. The government found itself trapped. It still needed to pay teachers, hospitals, pensions, public salaries. But every loan was becoming more expensive than the last. And then came the moment that should have been a triumph, the 100-year bond. In 2017, Argentina issued a century-long bond, something usually reserved for the most stable nations. Investors rushed in. The country raised $2.75 billion in a single day. Demand was so strong that the bond was oversubscribed. It was supposed to be a symbol of confidence. Instead, it became a symbol of collapse. Within just 3 years, the bond had lost 70% of its value. Inflation surged past 50%, then 70%, then 100%. By 2023, annual inflation hit 211%, and by 2024, it crossed 250%. A 100-year promise failed in less than a presidential term. That wasn't a crack anymore. That was a chunk of concrete falling off the dam. Governments facing that situation only have a handful of options: raise taxes, cut spending, default on their debt, or create more money. None of them are pleasant. Most governments try to delay the pain, and that's where the real spiral begins. At first, printing more money feels harmless. Nobody wakes up thinking the economy is collapsing. Life carries on. People still go to work. Restaurants are still opening. Football matches are still being played. From the outside, everything looks surprisingly ordinary. But beneath the surface, something has changed. The amount of money is growing much faster than the amount of things that the money can buy. And eventually, people notice. Not economists, but ordinary families. You get paid on Friday. By Monday, your groceries already cost a little more. Maybe it's only a few percent. Annoying but manageable. A few weeks later, prices rise again. Your parents convert some of their savings into dollars. Your colleagues buy a new washing machine. Not because they need one, but because they think it'll be more expensive next month. You begin doing the same. Not because you're panicking, because waiting suddenly feels risky. Now imagine millions of people making that exact same decision. People rush to spend their salaries as soon as they're paid. Shops sell out faster, businesses order more stock, suppliers raise prices, customers see price increasing, so next month they buy even earlier. Nobody planned this, nobody coordinated it. Every individual decision is perfectly rational, but together they create a vicious cycle. One where everyone is trying to protect themselves while unintentionally making the problem worse. This is exactly what happened in Zimbabwe. During the country's hyperinflation, many people spent their salaries the very moment they were paid. Not because they wanted to buy things, because waiting even until tomorrow could mean their salary bought less food. Imagine getting paid at 9 in the morning and knowing that by dinner your salary might already buy less than it did at breakfast. That's what happens when people stop trusting money itself. That's one of the strangest things about economics. Sometimes crises aren't created by irrational behavior. They're created because millions of perfectly rational people all respond to the same incentives. Money hasn't disappeared, but something much more important has. It's predictability. And without predictability, planning becomes almost impossible for families, businesses, and eventually for banks. Banks are built on the simple assumption that not everyone will ask for their money back at the same time. Most of the money sitting in your bank account isn't actually sitting inside a vault. It's financing someone's home, someone's business, someone's future. That's how modern economies work. But it also creates an uncomfortable reality. If enough people suddenly lose confidence, the system begins to strain. Imagine hearing a rumor that your bank is in trouble. You don't know if it's true, but withdrawing your savings seems like the safer option. After all, if everyone else is wrong, you can always redeposit the money later. The problem is, millions of people are thinking exactly the same thing. And sometimes that's all it takes. Sometimes a rumor is enough. No official announcement, no economic report, just a message in a family WhatsApp group. I hear the bank is running out of money. Maybe it's true, maybe it isn't. But if there's even a small chance your savings could disappear, what would you do? Most people would head straight to the bank. Not because they're panicking, but because they're trying to be sensible. And that's exactly the problem. If enough people think that way, the rumor becomes reality. That is called a bank run. Throughout history, banks have failed not because they suddenly lost billions overnight, but because too many people lost confidence at exactly the same time. The financial system only works if people believe it will still work tomorrow. Once that belief starts disappearing, the cracks spread incredibly fast, and the dam begins to groan under the pressure. That's exactly what happened in Lebanon. For years, the country attracted investors with generous interest rates. Banks looked healthy, people trusted the system, until they didn't. When confidence evaporated, people rushed to withdraw their savings. Imagine checking your bank account and seeing 100,000 euros, knowing it's yours, but being told that you can only withdraw a few €100 a week. Technically, you still have the money, but in reality, you don't. Businesses couldn't pay suppliers, importers couldn't buy medicine, fuel became scarce, shops struggled to keep products on their shelves. A banking crisis quietly became an economic crisis. And then it became a social one. Parents stood in pharmacies begging for basic medication. Electricity came for only a few hours a day. People cried in front of ATMs that no longer dispensed cash. The dam wasn't cracking anymore. Huge chunks flew off. And that is a sight that no one can miss. But perhaps the greatest loss isn't just money. It's people. Imagine you're a young software engineer, or a doctor, or an entrepreneur. You've watched prices rise for years. You've watched businesses close. You've seen your savings lose value. Then a company in Canada offers you a job, or Germany, or Australia. Do you stay or do you leave? For many people, the decision becomes obvious. One family leaves, then another, then another. Every departure makes sense on its own, but together they create another vicious cycle. The people most capable of rebuilding the economy are often the ones to leave first. Businesses struggle to find skilled workers, investment slows, innovation disappears, tax revenues fall even further. The government has even fewer options than before. The cracks become wider, the downward spiral accelerates. Eventually, the water doesn't even need another crack in the dam. The pressure alone becomes enough. By the time television cameras arrive, showing empty supermarket shelves, people fighting over basic goods, or stacks of worthless banknotes, the collapse has already happened. Those images aren't the beginning of the story, they're the ending. The dam didn't fail that morning. It had been leaking for years. And yet, there's still one problem, because if debt causes collapse, then why hasn't Japan collapsed? For decades, economists have pointed to Japan's enormous national debt as a ticking time bomb. Its debt is larger relative to its economy than almost any other developed nation. Its population is shrinking. Economic growth has been slow. On paper, Japan seems like the perfect recipe for disaster. Yet, government borrowing remains remarkably cheap. Investors continue buying Japanese debt. The banking system remains stable. Why? Because debt alone was never the real problem. Credibility was. Japan has spent decades building something that's incredibly difficult to measure and almost impossible to replace. Predictability. Investors believe Japan will honor its obligations. Businesses believe the rules won't suddenly change overnight. Families believe their savings will still have value tomorrow. The economy isn't held together by optimism. It's held together by confidence that the system will continue to function. Japan didn't have a stronger dam. It repaired the cracks before they spread. That confidence becomes self-reinforcing. People invest because they believe others will invest. Banks lend because they believe borrowers will repay. Consumers spend because they believe tomorrow will look much like today. The same feedback loop that destroys collapsing economies also protects stable ones. That's why countries with similar debt levels can have completely different futures. Debt is only the symptom. Confidence determines whether it becomes a crisis. History is full of countries that recovered from recessions, recovered from wars, recovered from financial crashes. But once credibility is lost, rebuilding it can take decades. You can print more money, you can raise taxes, you can elect a new government, but you can't print trust. It has to be earned, slowly, one decision at a time, exactly the way that is lost. Thanks so much for watching. If you enjoyed this video, consider subscribing to Rebel Economics, where we explore the hidden forces shaping our economies and our everyday lives. And check out the next video on the screen. Until next time, here on Rebel Economics.